We have a problem today, Carl, with industrials. There's three issues that are weighing on the market. Number one, you've got China issues. How much is the economy slowing down there? That's an active debate. You've got the 10-year sort of moving up a little bit. That's causing some issues. And finally, Carl's right. Industrials are taking hit. Let's just take a look at the sectors. You can see this here, slightly defensive tone. You've got utilities, consumer staples, the only thing that are up. Materials, emerging markets, weak again. That's the China story. Tech and the semis are weak, but there's your industrials, notably on the weak side overall. Just take a look at some of the companies that have reported. We talked about Sealed Air. They cited unfavorable currency and higher raw material and freight costs. Textron missed on the top and bottom line. Their forward guidance was weak. They joined a list of companies that have had some issues. PPG, Grainger, Fastenal recently, all similar comments. The bottom line, the common theme, margin pressure. They're talking about weaker foreign currency, tariffs. They're talking about higher raw material costs, higher labor costs. And then you throw in pockets of demand weakness in autos, particularly in China, a little bit in Europe. Well, you got a problem. You saw this today with the autos. Look at Ford and General Motors. Morgan Stanley talked about auto sales falling in China, and they seem rather concerned. They talked about 40% down year over year volume for Ford in China. That's quite remarkable if that's accurate. It's been an awful year. They're down 25% overall. Speaking of China, we saw another tough day for China. The China stocks to trade here. Your Baidus and your Alibaba, JDs.com, all on the weak side here. But it's just been an ugly year overall in China. The Shenzhen, which is sort of the NASDAQ of China, a lot of the tech stocks down dramatically, down 35, 36% there. Hong Kong, the mainland stocks, not down as much because it has more institutional ownership. Mainland China is mostly small retail players. They're not terribly sophisticated, and they scare very easily. I want to point out that the Chinese stock market is very small. $7 trillion in the mainland value. That's 1/4 of the United States value. We have a $30 trillion stock market in the United States. The bond market, we have a north of $50 trillion bond market. The bond market in China is 1/4 the size of the United States. Bank deposits also comparatively small number overall. So don't kid yourself. This is not necessarily the best indicator of the overall health of the market, particularly with the overall retail base that's in that. And I think you should be careful about drawing how much China's really declining the economy there based on what the stock market is doing. Just want to tell you about, I think, a very big deal in the asset management business. Invesco going in to buy Oppenheimer funds from Massachusetts Mutual in a stock deal. Look at this chart for the year. This has been an awful year for the asset managers overall. Most of them look exactly like this. Now, Invesco is a very big company, and I would point out that they have a very well-known ETF brand name. That's the PowerShares franchise. Just take a look at how the asset managers have done overall this year. Even your big leaders like BlackRock, for example, which also owns iShares, have been down rather dramatically. Put up that full screen, you see what we're talking about. Invesco's down more than 40%. Federated, Franklin, Legg Mason, and BlackRock. So yes, the problem is active management, but even the ETF providers like BlackRock and Invesco have seen their shares decline. And overall problem, it's just fee compression. Active management has been under assault for many years. We know this. Passive investing is growing. It's roughly 50% of the assets under management in mutual stock funds now. This is creating dramatically lower fee revenue that's not being made up very easily. There are alternatives like Smart Beta out there where you buy stock based on rules. It's quasi-active management. But even with that, the fee structure is much, much lower. And these companies are scrambling to find ways to keep up the fees that are the lifeblood of the companies overall. Again, it's not just the assets under management, it's how much you can bring in as a percentage of those assets, and that number has been going down for a while. Still just off the lows here, 130 to the downside on the Dow.